Credit card companies say they want responsible customers, people who pay on time, people who manage their finances carefully, people who avoid debt. But the customers who generate the most profit are usually the ones who carry balances. In the United States, credit card debt now exceeds $1 trillion. Interest rates on many cards are above 20%. Each month, millions of cardholders choose not to pay their balance in full. From the outside, that looks like a problem the industry should want to eliminate. In reality, it is the economic engine of the system. Most people assume credit card companies make money from transactions. Every time a card is swiped, the bank earns a small fee from the merchant. These interchange fees occur billions of times each year. But interchange is not the main source of profit. Interest is. When a cardholder carries a balance from one month to the next, the bank begins charging interest on the outstanding amount. With average APRs above 20%, the math compounds quickly. A customer carrying a few $1,000s of revolving debt can generate hundreds of dollars in interest each year. Multiply that across millions of accounts, and the scale becomes enormous. But the surprising part is not that interest exists. The surprising part is how the system quietly encourages behavior that produces it. Credit cards are built around the minimum payment. Each monthly statement shows the full balance and a much smaller required payment. Often the minimum is only 2 or 3% of what is owed. Technically, paying the minimum keeps the account in good standing. Economically, it stretches repayment dramatically. A balance that could disappear in months can persist for years if only the minimum is paid. During that time, interest continues to accumulate. The structure is subtle. It does not force customers into debt, but it changes the path of least resistance. And over time, small behavioral nudges produce large revenue streams. But here's the twist. The most profitable customers are not the ones who spend the most. Not all cardholders behave the same way. Some pay their balance in full every month. These customers are often called transactors. They use the card for convenience or rewards, but avoid interest entirely. From the bank's perspective, these customers are useful but not especially profitable. They generate interchange fees, but little else. The more valuable customers are called revolvers. Revolvers carry balances from month to month. They pay interest, sometimes for long periods of time. These accounts generate far more revenue than customers who pay their balance in full. In fact, a relatively small percentage of cardholders often produces a large share of industry profits. The economics become clearer when you look at how banks manage their portfolios. Credit card issuers oversee millions of accounts. Some customers default. Some pay in full every month. Others revolve balances and generate steady interest income. The objective is not to eliminate risk entirely. The objective is to balance it. If interest income from revolving balances exceeds the losses from defaults, the portfolio remains profitable. And this is where the system starts to look very different. Higher interest rates compensate for higher risk. Credit limits influence how much debt a customer can accumulate. Promotional offers attract new accounts that may eventually revolve. The system can appear complex, but the underlying incentive is simple. A cardholder who carries a manageable balance for years can be more profitable than one who pays every statement in full. That dynamic creates a quiet tension inside the system. Credit card companies promote responsible financial behavior. They encourage on-time payments and strong credit scores. At the same time, their most profitable accounts are often those that maintain some level of ongoing debt. This does not mean banks want customers to fail financially. Large defaults are costly and unpredictable. Charge-offs erase revenue and introduce volatility. The ideal customer is not someone overwhelmed by debt. It is someone who carries a balance consistently and repays it slowly. Enough interest to generate profit, not enough risk to trigger default. Once that dynamic becomes visible, many design choices start to make sense. Rewards programs encourage spending. Higher spending increases the chance that balances will roll over. Credit line increases expand borrowing capacity. Promotional financing attracts new users who may continue revolving after the promotion ends. Even the simplicity of tapping a card reduces friction in the transaction. Each feature seems minor. Together they shape behavior. There is also a broader network behind the system. Credit cards operate through issuers, payment networks, and merchants. Visa and MasterCard provide the infrastructure. Banks issue the cards and manage the accounts. Merchants pay interchange fees to accept electronic payments. This network generates enormous transaction volume, but the recurring interest from revolving balances creates a second, more durable revenue stream. Transactions create activity. Balances create profit. The distinction matters. If every cardholder paid their balance in full each month, the industry would still exist. Payments would still move through the network. Merchants would still pay interchange fees, but the economics would look very different. Interest income would shrink dramatically. Profit margins would compress. Incentives around lending and credit limits would change. The system would resemble a pure payments business. Instead, the modern credit card industry operates as a hybrid, part payments network, part consumer lending platform, and the lending side depends heavily on revolving balances. So when credit card companies encourage responsible behavior, that statement is only partially true. They want customers who repay their obligations and remain solvent. But the most profitable accounts are rarely the ones that eliminate their balance every month. The real profitability sits between full repayment and default, a balance that lingers, interest that compounds, a system built not just around transactions, but around time. Because in the credit card industry, the swipe is only the beginning. Credit card companies don't just process payments, they monetize time.